Hi, in this video, we will solve example sums for revaluation of assets and reassessment of liabilities at the time of retirement of partner. Both the methods will be discussed. Let's go to the first example sum. Example 1. A, B and C are partners sharing profits and losses in the ratio of 5:3:2. C retired, and on the date of his retirement, the following adjustments were agreed. A. The value of furniture is to be increased by rupees 12,000. Point B. The value of stock is to be decreased by rupees 10,000. Point C. Machinery of the book value of rupees 50,000 is to be reduced by 10%. Point D. A provision for doubtful debts at 5% is to be created on debtors of the book value of rupees 40,000. Point E. Unrecorded investment worth rupees 10,000. And point F. An item of rupees 1,000 included in bills payable is not likely to be claimed and hence should be written off. Pass the necessary journal entries. Also prepare the revaluation account. So we'll go to the solution. We'll begin with the journal entries. Solution. Journal. We have date, particulars, LF number, debit rupees and credit rupees. We'll begin the first entry by debiting the revaluation account. At point B, we need to debit the revaluation account because we need to decrease the value of stock. So to stock account, 10,000 rupees. Point C, we need to reduce the value of machinery. To machinery account, 10% of the book value, rupees 50,000, so it's 5,000 rupees. Point D, we need to create a provision for doubtful debts. The amount is 5% of debtors whose value is 40,000 rupees, so it's rupees 2,000. So we've done with the items to debit the revaluation account. The total debit to revaluation is 17,000 rupees, being revaluation account debited. The second entry, we will credit the revaluation account. We'll begin with point A. Furniture is to be increased by rupees 12,000. Next, point E. Unrecorded investment is worth rupees 10,000. Investments account debit 10,000 rupees. And finally, point F. Bills payable to be reduced. ₹1,000. We'll credit the revaluation account to revaluation account, 23,000 rupees. narration being revaluation account credited. The final journal entry, the total of the debit is rupees 17,000 and the total of the credit to revaluation is 23,000. So there's a gain on revaluation account. Amount of gain is the total of the credit side 23,000 minus the total of the debit side 17,000. So there's a gain to the extent of 6,000 rupees. Revaluation account debit, 6,000 rupees to A capital account, to B capital account, and to C capital account. The gain of 6,000 to be divided in OPSR between A, B and C, which is 5:3:2. So we have 3,000 rupees against partner A, 1,800 rupees against partner B, and 1,200 rupees against partner C. Narration being gain on revaluation transferred to partners' capital accounts. I'll remove the split. We can view all the three entries together. These are the three journal entries to be passed for this first example sum. Let's prepare the ledger account, revaluation account next. Revaluation account. Left side debit side, right side credit side. We have particulars, rupees, particulars, rupees. Point A, the value of furniture is to be increased by rupees 12,000. By furniture account, 12,000 rupees. Point B, the value of stock is to be decreased by 10,000 rupees. To stock account, 10,000 rupees. Point C, machinery of book value of rupees 50,000 is to be reduced by 10%. So to machinery account, 5,000 rupees. Point D, a provision for doubtful debts at 5% is to be created on debtors of book value of rupees 40,000. So to provision for doubtful debts, 5% of 40,000 is rupees 2,000. Point E, unrecorded investment worth rupees 10,000. By investment account, 10,000 rupees. And point F, an item of 1,000 included in bills payable is not likely to be claimed and hence should be written back. So by bills payable, 1,000 rupees. The items are done. We'll balance the revaluation account. The greater total is on the credit side, 23,000 rupees. There's a gain on revaluation transferred to partners' capital accounts. We have partner A, partner B, and partner C. The total on the credit side, 23,000, minus the amount of total of the debit side, 17,000 rupees. We have a gain of 6,000 rupees to be distributed in OPSR 5:3:2. So we have rupees 3,000 against partner A. We have rupees 1,800 against partner B, and rupees 1,200 against partner C. So this is a revaluation account, the ledger account for this example sum 1. We use the first method because there was nothing specified in the sum. So we use the first method. Example 2. X, Y, and Z were partners in a firm sharing profits in the ratio of 3:2:1. Y retired and X and Z decided to share future profits in the ratio of 3:2. On the date of Y's retirement, the assets were revalued and liabilities were reassessed as under. First point, stock was found to be undervalued by rupees 10,000. Second point, machinery was found to be overvalued by rupees 14,000. Third point, an amount of rupees 3,000 included in creditors was not likely to be claimed and hence should be written back. Fourth point, it was decided to provide rupees 6,000 as claim for damages. Fifth point, an amount of rupees 300 debited to the profit and loss account as insurance premium was to be carried forward to the next year. Sixth point, outstanding salaries is rupees 5,000. You are required to pass a single adjustment entry to give effect to the above on the retirement of partner Y. So when they say we need to pass only a single adjustment entry, only one entry to be passed, we know we need to follow the second method. So let's begin with the solution. We'll do the working notes first. Working notes. Step 1. We need to find out whether there's a gain or loss on revaluation. The first point, stock was found to be undervalued by rupees 10,000. Comes under add. Point 2, machinery was found to be overvalued by rupees 14,000. Under less. 3, an amount of 3,000 rupees included in creditors was not likely to be claimed and hence should be written back. That's an add. Point 4, it was decided to provide rupees 6,000 as claim for damages. So that's under less. Point 5, an amount of rupees 300 debited to profit and loss account as insurance premium was to be carried forward to the next year. So it's prepaid insurance under add. And last point, outstanding salaries rupees 5,000 against less. The total of the add comes to 13,300 rupees and the total of the less comes to 25,000 rupees. So there's a loss of rupees 11,700. So now the step 2 is to calculate the gain or sacrifice of each partner. As per the problem, old profit sharing ratio between X, Y and Z is equal to 3:2:1. Y is the partner who retires, and the NPSR between X and Z is also given as 3:2. So for partner X, old share 3/6 minus the new share 3 divided by 5. A negative 3 divided by 30, and X gains. For partner Z, old share 1/6 minus the new share 2 divided by 5. A negative 7 divided by 30, and Z also gains. Hence, the gaining ratio between X and Z is equal to 3:7. Let's pass the journal entries. Solution: date, particulars, LF number, debit rupees, and credit rupees. We have a loss on revaluation, so we need to debit the sacrificing partner or the retiring partner and credit the gaining partners. So let's do that. The retiring partner is Y capital account, debit, to X capital account, to Z capital account. Against partner Y, 11,700 multiplied by Y share, which is 2 divided by 6. 3,900 rupees. Against partner X, 3,900 into 3 divided by 10. And against partner Z, 3,900 into 7 divided by 10. 1,170 against partner X. And 2,730 rupees against partner Z, being single adjustment entry passed to give effect to revaluation of assets and liabilities. So this is a single adjustment entry that needs to be passed using the second method.